Ever looked at a chart and thought, that looks like it's about to turn, but couldn't quite put your finger on why? That's usually your trader instinct trying to tell you something. And in many cases, that something is a reversal pattern. Now, whether you're a budding day trader, experienced investor, or anything in between, understanding reversal chart patterns can help you spot when a trend might be running out of steam. That's useful information. You can use reversal patterns to get in at the start of a new trend or get out of an open trade at the end of a trend. Today, we'll go through the 4 main reversal patterns you want to be looking out for, and I'll show you how to trade them properly using the WeTrade app, including where to set your entry, your stop loss, and your target. Hi guys, I'm Jasper, market analyst for WeTrade and founder of Trading Writers, and I'm here to help improve your trading education. It's important to understand both the opportunities and risks involved. Online trading can be rewarding, but it can also carry significant risks, including the potential loss of your invested capital. Make sure to educate yourself and consider your risk tolerance before getting started. Let's start with the basics. What exactly is a reversal pattern? It's a shape made up of usually at least 20 bars of candlesticks that form on the chart when a trend is losing strength. If prices have been climbing and then start forming certain peaks and troughs that fit a familiar pattern, that might be a sign that the buyers are running out of puff. If prices have been falling, those same shapes but upside down could mean that sellers are getting tired. Price charts almost by definition look messy, but human behavior leaves patterns and those patterns repeat. So the trick is spotting them. When I hold webinars with clients on technical analysis, something I'll do is take the ticker symbol off a series of charts, especially the ones people have open trades in. Then sometimes I'll even flip the charts upside down. It's amazing how easy these patterns become to spot once you strip away some of the pre-existing biases that people have about what a market is going to do next. Alright, next up I'll cover the main patterns, then go over how to trade them. The entry-exit techniques are actually pretty universal across all the patterns. By the way, if you're getting some value from this video so far, please tap that little thumbs up icon down there. It really helps spread the word about these videos. Alright, the classic double top and double bottom. These are 2 of the simplest and most reliable reversal patterns you'll ever see. The double top forms after an uptrend and is bearish reversal pattern. Price rallies up to a level, pulls back, tries again but can't break that same peak. It's like the market saying, sorry my friend, that's too expensive. After the second rejection, the price needs to fall beneath the trough formed between the 2 peaks for the pattern to be complete. You can draw a horizontal line through here, that's called the neckline. The double bottom looks just the opposite, and it's a bullish reversal signal. After a downtrend, the price hits a low, bounces, then revisits that same level and holds. Buyers step back in saying that's cheap enough, we'll have another go. This time, the pattern completes when the price breaks above the neckline, which is drawn at the peak between the 2 troughs. Now here's how to trade it. For a double top, when price breaks below the neckline, that's your signal the uptrend's over. On the WeTrade app, you'd place a sell stop order just under that neckline level. Measure the distance from the neckline to the top of the pattern and project that distance down from the neckline. So if the peak is 100 pips above the neckline, you're aiming roughly 100 pips below it. Then add your stop loss should go some safe distance above the neckline. For a double bottom, when the price breaks above the neckline, that's your cue. On WeTrade, set a buy stop order just above that level. Your target is the same idea as before. Measure and project upwards from the neckline. And your stop loss goes just below the neckline. Okay, the triple top and triple bottom. You can just think of these as the extended remix of the double patterns. The triple top has 3 peaks and the triple bottom has 3 troughs. What's happening here is that the price is trying not twice but 3 times to break through a key level and eventually failing. Each attempt fails. When that neckline finally gives way, the move that follows is often stronger because there's the build-up of frustration and trapped traders getting squeezed out. Now, one thing I've noticed over the years, especially trading indices like the FTSE or the DAX, is that these patterns often form around psychological levels. You'll see the price test 8,000 3 times and fail, or hold 7,000 3 times and bounce, which makes sense. If a big institution is planning to enter or exit a large position, there's no need to fine-tune it by the point. They'll choose the big round numbers to do so. The trade logic is just the same as the double top. Wait for the breakout, confirm it with a close beyond the neckline, set your order in the direction of the new trend, and use the height of the pattern to project your target. Now we've arrived at the most famous pattern in all of trading, and that's the head and shoulders. And no, I'm not talking about the shampoo. Sorry, not too original there. The H&S, as it is often short to, appears at the end of a uptrend and is a bearish reversal pattern. You'll see a peak, that's your left shoulder, and then a higher peak, the head, and finally a lower high, the right shoulder. When price breaks the neckline, that's your cue that buyers have given up. The inverse version, the inverse head and shoulders, is just flipped upside down and is a bullish reversal pattern. Now the thing about this pattern is that it often shows up around major turning points, those moments when the market narrative is itself shifting. The entry technique is again on the break of the neckline, with the head of the pattern used to project the price to the place where you set your take profit limit order. And again, a stop loss can go just past the neckline or just beyond the right shoulder for a wider option. The rising wedge and falling wedge differ from the other main reversal patterns because they involve a sloping neckline as well as sloping peaks and troughs. I'll show you what I mean in a second. A rising wedge forms when price keeps making higher highs and higher lows, but the higher highs form a flatter trend line than the higher lows do. Momentum's fading and the buyers running out of enthusiasm to keep pushing the price significantly higher when forming new higher highs. Eventually, the lower trend line breaks and the pattern is complete. As always, the falling wedge is the mirror image. You're in a downtrend, but the sell-offs are getting shallower. That's usually the early warning of a reversal to the upside. Same rule as always on the entry. For the targets, the textbook approach is to take the full height of the wedge and project it from the breakout point. For stops, again, beyond the neckline, or if it's close enough, you can use the last peak or trough on the other side of the wedge. Let's talk about a few classic mistakes traders make with reversal patterns. Mistake number one, seeing patterns everywhere. Once you learn these, you'll start seeing them on every chart. Trust me, I've been there. Back when I first started, I thought every zigzag was a head and shoulders. The trick is to think about the overall context and be selective. Combine the patterns with other tools like support and resistance, trend identification, and technical indicators. Mistake two, jumping the gun. You can anticipate the breakout, but wait for a confirmation, a close or a strong move beyond the neckline. Remember, trends usually continue, a reversal is the exception. By the way, make sure to watch my video on continuation patterns for more on this. Mistake three, no stop loss. This one's self-explanatory. Even the best looking setup can fail. Protect your capital first, profits come later. So why do these patterns even work? It's not geometry, it's behavior. Every time price fails to make a new high or low, it chips away at the confidence of the dominant side. Buyers who were sure the rally would continue start to doubt themselves. Sellers who missed out earlier start getting braver, and before you know it, the balance of power shifts. That's what these patterns capture, the turning of the tide between greed and fear. All right, quick recap here are your 6 key reversal patterns: the double top, double bottom, triple top, triple bottom, head and shoulders, inverse head and shoulders, rising and falling wedges. And the beauty of the internet is that many analysts and traders have drawn out these patterns on, I'm sure, thousands of charts, if not millions. Go have a look at them to inspire you when drawing some fresh ones on your own charts. So that's reversal chart patterns in a nutshell. Next time on the WeTrade app, try spotting a few of these in real markets. Use the drawing tools to mark your trend lines and necklines and test your pattern recognition skills without risking real money first. Once you start to see these patterns clearly, you'll never look at a chart the same way again. And remember, no pattern works 100% of the time. The goal isn't perfection, it's probability. Combine these setups with good risk management, a clear pan, and a bit of patience, and you'll give yourself a genuine edge. All right, that's all for today. And if you find this video helpful, please like it or share it with other traders, and let me know in the comments which reversal pattern you trust the most. Please smash that like button and subscribe to see more videos like these as soon as they're released. And thanks very much for watching, everyone, and happy trading.